This is Tim Phillips, Chief Investment Officer at Phillips & Company Advisors, and I'd like to welcome you to our Q2 2021 look ahead. Please read all the disclosures carefully. The coming quarter will be a period of rapid reopening with vaccine availability occurring much faster than anticipated. By mid-April, 90% of all adults will be eligible for a vaccine, and we should reach herd immunity by mid-May. That will likely push up consumer confidence to pre-pandemic levels. While jobs are critical in the long run, in the short run, confidence will matter most in getting consumers back to spending and leveraging up. If consumers ratchet up credit card debt and increase their interest payments, we could see unanticipated consumption patterns that will strongly benefit the U.S. economy. We know the U.S. government has pulled off a highly unlikely triple play, the first being fiscal support. And really, it's a brand new policy tool that's always been available to the U.S. government, but rarely successfully used. With a $1.9 trillion package, we should see an 8.7% bump to GDP that will lift support to the economy throughout this year and next year. The government also tacitly boosted the implied minimum wage by adding massive stimulus to the unemployed. The get back to work equivalent wage will need to be in the $19 an hour range, and this will dramatically boost lower income workers' ability to spend, as most of those folks work in the service sector. It might create some transitory inflation, but that appears to be acceptable to policymakers and investors. The second part of the triple play is impacting the personal savings rate as a flow control to consumptions. Consumers initially saved their first stimulus checks and then spent down about 14% a month from April till November last year. The passage of the $900 billion package boosted precautionary savings again in January and February. With the $1.9 trillion, we see another jump in savings similar to last April. It's not hard to forecast the consumer spend down will take us through at least January 2022 to restore us to pre-pandemic savings level. Overall boost from the combined spend down is around 12% of GDP, much greater than the latest stimulus suggests. The third part of the triple play is the monetary. The Fed was the first to run to the rescue of the U.S. consumer by dropping rates to zero and then forecasting they'll remain there likely through 2022. Even with massive fiscal and monetary stimulus, the forward inflation rate is only suspected to be around 2.4%, not far above the Fed target. While the yield curve and interest rates are rising, we don't believe the Fed will react until we see mortgage rates spike to about the long-term average of 4.25%. And again, we're a long way off from that occurring. Let's just take a moment and expand on the Fed and interest rates. We know the Fed has two mandates: maximum employment and price stability. Midway through the pandemic, the Fed basically threw the price stability mandate to the wind and is now focused on maximum employment with wage growth on the lower end. Chairman Powell said as much in the quote provided on this slide. Looking at those in lower wage industries, mostly in the service sector, you can see Black and Hispanics impacted the most. It's clear the Fed wants to boost their wages before addressing inflation. While we know there's a, quote, get off the couch tacit minimum wage that must be paid between now and September, the Fed will help as well with letting inflation run a bit. You can see we have made some progress in that wage gap between lower wages and the overall wage. The real key will be in labor force participation, and with the bouncing off the bottoms, we can anticipate no indications from the Fed in the coming quarter to higher interest rates. Our bottom line is, in any case, we believe that inflation impacts are transitory. First, a natural overstatement of inflation occurred during COVID due to supply chain disruptions. Labor force supply is also abundant, and that will have a dampening impact on inflation. Further, you can see in the upper right-hand corner, the Fed has fallen short of its inflation targets for many years, and we think that's going to continue to be the case. We also believe slightly rising inflation helps lots of asset classes, including the standard 60-40 portfolio. Fixed income is the first part of a two-part story for some challenges ahead this quarter. Banks have been sitting on massive levels of treasury bonds and really recently sold those off due to some changes in Federal Reserve policy. That boosted cash levels at banks, driving money market rates to near zero, and those might actually go to negative. It also raised long-term rates that crushed some fixed income investors. For example, if you were holding long duration treasuries, you would have seen over 16% drop in your values. It's clear the safest part of the yield curve will be in the 2-year to 5-year range, but that will pose some challenges to fixed income managers. It'll also reduce income and lower some of the benefits to fixed income investing. The other challenge or opportunity is on U.S. equities. Valuations are at historically high levels, and that always creates some extra volatility. The good news is the base effect, or the low hurdle rate for corporate earnings coming off the COVID deep freeze, is easy to beat. You can see we should well exceed those rates by wide margins. Some of this is built into current expectations. Any disappointment to these expectations might be met with a reversion to the mean in valuations. If equity prices do nothing from here to the end of the year, we could see valuations return to normal with a 35% implied growth rate. If we get the expected 25% growth rate, we could see a drawdown in U.S. equity prices. And in the unfortunate circumstance of no S&P 500 earnings growth rate, it would require the S&P 500 price to drop by 26% to return to normal valuations. Again, our expectations are for S&P 500 companies to earn between that 25% and that 35% for 2021. Developed markets provide a rebound in earnings, but at higher valuations than the U.S. or emerging markets. These economies will bounce back in Q2 and Q3 to pre-pandemic GDP growth levels, but the elevated valuations and low systemic growth rates keep us underweight these economies. Conversely, emerging markets will have much higher earnings growth rates than the U.S. and developed markets, and at much lower valuations. These economies will return to pre-pandemic GDP growth rates in Q2, and both India and China will likely have tremendous economic activity throughout 2021 and 2022. In terms of emerging markets, China is the dominant player. They're expecting a full bounce back in 2021 with targets of 6% GDP growth, but most economists expect this to exceed 8%. Industrial production should boom in Q2 with the addition of the service sector coming back online. China's 14th fifth-year plan is focusing on more urbanization, green energy, more growth in disposable income at the same rate as GDP growth, and a more independent approach to food and energy production. The crossover point when China becomes the global leader in terms of economic power is still targeted for 2028, and this is causing U.S. policymakers considerable indigestion because we have never not led the global economy since like the 1870s or so. One special note is our focus on industrial metals. We continue to believe we are at the early stages of a cyclical bull market in industrial metals, particularly copper and rare earths. We think we're in a recovery and expansion phase that will boost returns in commodities and also lift lower wages. Industrial production is the main driving force, but a shift to electric vehicles in China will be a persistent factor for copper demand in the coming decades. Our mean reversion dashboard still shows extremely elevated valuations across style and size across most regions, with better valuations in Russia, Brazil, and China, and sectors with some outliers like financials, healthcare, and utilities. You can review our economic dashboard here. You can read our views and recommendations here, but the overall theme is we expect a full recovery in corporate earnings, and much of that's already priced into U.S. equities. Of course, the vaccine is going to be the main driver for a full U.S. economic recovery. We know the Fed's going to stay on hold to help lower income Americans get a boost to their wages. Of course, we expect China to continue to increase their global presence through major trade alliances and vaccine diplomacy in Africa, Latin America, Southeast Asia, and the Middle East. In our estimation, emerging markets present the most attractive valuations, and we do think in the second quarter, President Biden will focus on infrastructure and reorganizing tax policy. Finally, we do believe there is a beginning to a secular bull market in base metals, and we think that's an opportunity for investors to take advantage of. Continue to maintain policy weights in U.S. equities. Make sure you're actively managing fixed income. As yield chasers increase, defaults across the credit markets will have a greater impact. Keep focused on emerging markets with a specific overweight to China domestic equities. And again, consider some exposure to industrial commodities. I'd also like to refocus your attention back to our discussion we had with award-winning financial author Morgan Housel about his book, The Psychology of Money, and you can see that link here. Thank you again for your time and attention. And if you have any questions or comments, please direct those to your advisor, or you can email me at my email address on this link.